Have you ever logged into your brokerage account, looked at one of your stocks, and your heart just sinks because the price has suddenly tanked, even though there's no bad news? It's confusing, right? Well, these events are called corporate actions, and they're actually pretty common. So let's get right into it and decode what's really going on behind those numbers.
So picture this. You own a share that was trading at, say, 1,200 rupees yesterday. You check it today, and it's sitting at 600. Whoa! Your first thought is probably, oh no, I've just lost half my investment.
But hang on. Before you hit the panic button, is it possible something else is going on here? In this explainer, we're going to break down the three most common corporate actions: stock splits, bonus shares, and right shares, so you can turn that moment of confusion into one of real understanding.
All right, first up, the stock split. And to really get what a split is, you first have to understand the problem it's trying to fix.
You see, when a company does really well, its share price can just climb and climb and climb until it gets so expensive that it's hard for new, smaller investors to even buy a single share. This kind of puts a cap on how many people can get in on the action. So, what's the company to do?
Let's put some numbers on this. Let's say a company's share is trading at a hefty 1,200 rupees. For a lot of people just starting out, that's a pretty big chunk of change for just one share.
So here's what they can do. They can announce a 2-for-1 stock split. If you own that one share worth 1,200 rupees, the company basically takes it and gives you back 2 shares instead. Now, each of those shares is worth 600 rupees. The key thing to notice is that the total value of your investment is still 1,200 rupees. Your overall wealth hasn't changed one bit.
Honestly, the best way to think about it is like a pizza. A stock split doesn't make the pizza any bigger. It just cuts it into more slices. You still have the exact same amount of pizza, it's just in smaller, more manageable pieces. The company's stock is now more accessible, but its total value is exactly the same.
Okay, so that's stock splits. Now let's talk about something that looks almost identical on the surface: bonus shares. But, and this is a big but, there's a critical difference hiding under the hood.
A bonus issue is basically the company's way of rewarding its shareholders. Instead of handing out cash, they take their accumulated profits, their savings or reserves, and use them to issue brand new shares to you for free.
Let's go right back to our 1,200 rupee share. Now, if the company announces a 1-for-1 bonus, it means for every share you hold, they give you one more. So your one share, poof, becomes 2. And just like with the split, the market price adjusts, cutting itself in half to 600 rupees. Once again, your total investment value stays the same.
Wait a minute. A 2-for-1 split left you with 2 shares at 600. A 1-for-1 bonus also leaves you with 2 shares at 600. Your portfolio looks exactly the same. So what gives? Why do companies have 2 different ways of doing what seems like the exact same thing?
And this, right here, is probably the most important part of this whole explainer. The difference is subtle, I'll give you that, but it can have a huge impact on your potential earnings from that stock down the road. Okay, so here's the crucial point. A stock split literally just divides your existing share into smaller pieces. When it does that, it also divides a little thing called the face value of the share. A bonus, though, is totally different. The company is creating brand new shares from its pot of savings. And because of that, the face value of your shares remains unchanged.
So why should you care about this technical term, face value? Well, you should care a lot, because dividends are almost always declared as a percentage of the face value, not the market price you see on your screen. And this is where things get really interesting for your bank account.
Let's make this crystal clear with some numbers. Let's say the original face value of our share was 10 rupees. Now, if the company declares a 100% dividend, that's 10 rupees per share. After that 2-for-1 split, your face value gets cut in half to 5 rupees. So that 100% dividend now gets you only 5 rupees per share. You have 2 shares, so your total dividend is 10 rupees. But with the bonus issue, your face value never changed. It's still 10 rupees. A 100% dividend still gets you 10 rupees per share. And since you now have 2 shares, your total dividend is 20 rupees. That's double the payout. See, it's a huge difference.
So splits and bonuses are all about adjusting the shares you already own, and you pretty much just sit back and let it happen. But what happens when a company wants to raise new money by offering you more shares? Well, that brings us to our final topic, right shares.
A company might need more cash to expand or maybe pay off some debt. They could go get a loan from a bank, but that means paying interest. Another way to do it is to go to the people who believe in them the most, their existing shareholders.
And they do this through what's called a rights issue. Think of it like an exclusive invitation just for you. They're giving you the right to buy new shares, usually at a pretty sweet discount to the market price.
The key word here is right, not obligation. You can choose to buy them, you can ignore the offer, or you can even sell your right to another investor.
So for example, a company might announce a 1-for-2 rights issue. All that means is for every 2 shares you currently have, you get the right to buy 1 new share at that special discounted price.
Whew, okay, we've covered a lot of ground here. Splits, bonuses, rights. Let's pull it all together so you know exactly what to think the next time one of these announcements pops up for a stock you own.
This table sums it up perfectly. A stock split is all about affordability. For you, it means more shares at a lower price, and you don't have to do a thing. A bonus share is a reward. It looks similar, but the real prize is the higher potential for future dividends. Again, no action needed. And finally, the right share. This is the different one. Its purpose is to raise capital, and it gives you an opportunity to buy more shares at a discount. This is the only one where you actually have to make a decision.
And that leads us to a final thought for you to chew on. Now that you understand the mechanics, especially that long-term dividend benefit of a bonus share, here's a question. If a company you own is sitting on a big pile of cash, what would you rather they do? Give you a one-time cash dividend today, or issue a bonus share that could mean a bigger stream of dividends for years to come? The answer really says a lot about your own personal investing strategy, something to think about.